Have you ever sat down at the end of a long month, opened your business bank account, seen a number that should feel good, and still felt this knot in your stomach? Like the money came in, but somehow there's more chaos, more stress, and more things breaking than when you were making less? You're not imagining that. That feeling has a name. It's called a threshold crisis, and it kicks in the moment your small business crosses $100,000 in revenue. My name is Mark, and I spend way too much time studying the mechanics of how money actually works inside small businesses so you don't have to. And here's what I can tell you. Most business advice treats $100,000 like a trophy, a number to celebrate, pop the champagne, post the screenshot. But the data tells a completely different story. $100,000 isn't a finish line. It's a trapdoor. The rules of your business literally change underneath you, and most founders don't realize it until they're drowning in the consequences. So here's what we're going to do. If you stick with me to the end of this video, you're going to see your business, your role inside it, and every financial decision you make from this point forward completely differently. We're going to break down exactly why $100,000 is the most dangerous and most powerful moment in your entrepreneurial journey, and what the research actually says happens to founders at this stage, and the two paths sitting in front of you right now that determine whether this number becomes your launch pad or your permanent ceiling. Let's get into it. Most people think $100,000 in business revenue is just a nice round number, a flex for social media, a screenshot for the group chat. It's not. It's a line in the sand. And on one side of that line, you have a hobby. On the other side, you have a real business. Why? According to administrative data, the vast majority of non-employer firms, that's businesses without any employees, stay permanently trapped under $50,000 a year. Not temporarily, permanently. That's not bad luck. That's a structural ceiling. Most businesses never even get close to six figures. They're born, they flatline, and they quietly disappear. Nobody writes articles about them. So when you cross $100,000, you're not just hitting a milestone. You're proving something critical. You're proving that your product market fit isn't a fluke. It's not your mom buying your candles. It's not your college buddy throwing you a pity contract. It means strangers, real customers, are finding you, choosing you, and paying you repeatedly. That's called a repeatable acquisition model. And it's the difference between a business and a GoFundMe page. Here's where it gets real. At this revenue level, your business finally demonstrates something called unit economics. That means the cost of getting a customer is genuinely lower than what that customer is worth to you over time. Before $100,000, you might be losing money on every sale and not even know it. After $100,000, the math actually works. Not just the hustle, the math. And according to JP Morgan Chase research, most small businesses start with revenues under $100,000. That means crossing this line puts you in a completely different category. You've cleared the first major league hurdle. Data from the SBA backs this up. Businesses reaching this revenue level have officially moved past what researchers call stage one, existence. That's the phase where your only goal, your only prayer, is simply not running out of cash tomorrow. You're past survival mode. You're into something new. But here's the open loop I need you to sit with. Getting to the $100,000 is hard. What comes next is harder. Because this number doesn't just validate you, it exposes you. And the first thing it exposes is a crisis you never saw coming. There's a business growth model created by researchers named Churchill and Lewis. They mapped out 5 stages of small business growth, and $100,000 in revenue, that's almost always where stage 1 ends and stage 2 begins. Stage 1 is called existence. Stage 2 is called survival. And despite the name, survival is actually harder. Why? Because in stage 1, the question is simple. Can we get a customer? That's it. Can anybody pay us money for this thing? But in stage 2, the question completely changes. It becomes, can we deliver to all these customers without me doing every single thing myself? And that question breaks people. Here's the brutal mathematics. You as a single human being have a fixed number of hours in a day. When your business was doing 30 or 40,000 a year, you could personally handle most of it. You answered the calls, you fulfilled the orders, you did the bookkeeping at midnight, but at $100,000, you physically run out of hours. The owner as the business model stops working, not because you're lazy, because there literally aren't enough minutes in a week. Research highlights that at this revenue density, the founder must transition from being the doer, the person who executes every task, to the manager, the person who orchestrates other people's execution. And if you don't make that transition, total operational collapse. That's not dramatic language. That's the research. Here's the thing that makes this so painful. You succeeded by doing everything yourself. Your personal touch, your quality control, your direct relationships with customers. That's what built this. And now the business is telling you to stop doing the very thing that made you successful. That's the paradox. Your greatest strength becomes your greatest bottleneck. The index of complexity, which is just a fancy way of saying the sheer number of different tasks your business requires, outpaces any single person's ability to supervise everything. You can't be the salesperson, the fulfillment team, the accountant, and the strategist simultaneously. Not at this volume. And most founders resist this. Hard. Because letting go feels like compromising quality. It feels like betrayal. You built this with your hands and someone's telling you to hand it off to a stranger? But here's the test that reveals the truth. Can your business survive your weekend off? Can you leave for 2 days and have nothing catch fire? At $100,000, you need standard operating procedures robust enough to pass that test. And most founders can't pass it. The management skills gap hits like a wall. Most founders are technical experts or natural salespeople. They're not trained managers. And this milestone reveals that gap brutally. You suddenly need to supervise people, and nobody taught you how. So what does this all lead to? A prediction. A data-driven prediction about where your business is actually headed. And the numbers are more brutal than you think. This is where it stops being theory and starts being cold, hard statistics. A landmark study from the J.P. Morgan Chase Institute found something that should make every small business owner pay attention. Your initial revenue level, specifically whether you start above or below $100,000, is the single strongest predictor of whether your business will ever reach $1 million. Not your industry, not your location, not your marketing strategy, your revenue starting point. Let that land for a second. Firms starting with under $100,000 in revenue are statistically far less likely to hit $1 million within their first 5 years. The data is stark. It's not a gentle slope. It's a cliff. Businesses that stall under $100,000 often lack what researchers call operational velocity. That's the momentum required to overcome the fixed costs of scaling. Think of it like a rocket. If you don't hit a certain speed, you never escape the atmosphere. You just fall back down. But here's the flip side. There's real evidence that crossing $100,000 creates momentum. Businesses that hit this mark tend to keep growing. Businesses that hover below it tend to stay there indefinitely. It's not random, it's a pattern. And the study found something else. The $100,000 mark is the crucial filter that determines which businesses get access to growth capital. Banks and online lenders, as documented in the 2025 Fed Credit Survey, typically require a 6-figure revenue history just to qualify for traditional business lines of credit. Below $100,000, you're in a completely different lending category. You're essentially invisible to the financial system that funds growth. This creates what I call a self-reinforcing cycle. Better financial reporting, which firms crossing $100,000 tend to adopt faster, leads to better capital access. Better capital access leads to faster growth. Faster growth leads to more sophisticated operations, and the entry point to this entire virtuous cycle, crossing $100,000. Below this threshold, you're limited to bootstrapping or personal credit cards. Above it, you suddenly have options. Debt, equity, strategic reinvestment. You have optionality. And optionality is power. But none of that optionality matters if you're hemorrhaging money to the tax system because you never optimize your financial structure. And that's exactly what happens to most founders at this stage. Let me be blunt. If your business is earning $100,000 and you haven't looked at your tax structure, you're leaving money on the table. Real money. Money that could fund your next hire, your next product line, your next phase of growth. In the United States, $100,000 in revenue, or roughly $40,000 to $60,000 in profit, is the widely accepted mathematical sweet spot to elect S-Corp status. This isn't speculation. This is tax strategy backed by accountants and tax professionals across the board. Why does this matter? Because as a sole proprietor, you pay self-employment tax on everything. Every dollar of profit gets hit. But with an S-Corp election, you can split your income between a W-2 salary you pay yourself and owner distributions. The distributions aren't subject to self-employment tax. That's not a loophole. That's the tax code working as designed. And it's the first time a founder at this level can actually use it effectively. Here's where it gets ugly for the unprepared. Research shows a massive spike in accounting software spending once businesses cross $100,000. Why? Because shoebox accounting, that pile of receipts in your desk drawer, catastrophically fails at this level. You can't track margins with vibes and guesswork when you're making financial decisions at this volume. Imprecise margin tracking at $100,000 will actively kill your business. Cash flow management transforms completely. Below $100,000, cash is purely for survival. Keep the lights on, pay your phone bill. Above $100,000, retained earnings become a growth engine. That money isn't just for surviving anymore, it's fuel. And this is the moment where real-time financial dashboards stop being a luxury and become a necessity. You're making decisions too fast, too frequently, to wait for a monthly bank statement to tell you where you stand. The tax savings alone from proper S-Corp election or other optimization strategies can be reinvested directly into hiring, marketing, or inventory. Your optimization literally funds your expansion, but only if you set it up. And most founders don't, because they're too busy doing everything themselves. Which brings us to the crisis nobody warns you about, the one where all your scrappy bootstrapped do-it-yourself systems start actively working against you. You know that Google sheet you built at 2 a.m. to track your orders? The one held together with formulas you barely understand and color-coded rows that only make sense to you? At $30,000 in revenue, that spreadsheet was genius. At $100,000, it's a ticking time bomb, and this is what's called the tech debt payoff moment. Before $100,000, you use scrappy free tools and manual workarounds because you're saving money. Smart. But after $100,000, those same manual processes start costing you more in wasted time and errors than actual software would. The free tool isn't free anymore. It's the most expensive thing in your business. Standard operating procedures become non-negotiable. Not because some business guru told you to write them, because without them, your business literally cannot function if you step away. Every process that lives only in your head is an existential threat to your company. If you can't document it, you can't delegate it. And if you can't delegate it, you can't grow. Period. Here's the thing. This revenue level is specifically where you can afford your first specialist hire, a fractional virtual assistant, a bookkeeper, a part-time sales rep. This moves your business fundamentally away from the founder as generalist model. You stop being the person who does everything and start being the person who makes sure everything gets done. That's a completely different job. The transformation moment, the one that changes everything, is when growth becomes a result of systems rather than a heroic effort. When revenue goes up not because you pulled another all-nighter, but because your process works. Hustle doesn't scale. Systems do. And here's something most people miss. At $100,000, the risk and volatility of your business actually decreases. You have a proven customer base. You have repeatable systems. Your business has value beyond just you and your equipment. Below $100,000, your business is essentially worthless to an outside buyer because it's completely dependent on your personal involvement. Above $100,000 with proper systems, it becomes an actual sellable asset. That's the difference between owning a job and owning a business. But without systematization, customer experience becomes wildly inconsistent. The same growth you fought for starts damaging your reputation. And the founder burnout at this exact stage is severe. You're trying to maintain $30,000 level personal involvement while handling $100,000 level volume. That is mathematically unsustainable. And that math doesn't just break your business, it breaks you. Nobody talks about this part. Not the business podcasts, not the motivational speakers, not the LinkedIn posts with the revenue screenshots. When you cross $100,000, something happens to you. Not your business. You. If you've defined yourself as the person who does it all, the grinder, the hustler, the one who never takes a day off, then the transition to management creates a genuine identity crisis. Who are you if you're not the one doing the work? If you're not packing the orders, closing the deals, answering every customer email, the work was your identity. And now the business needs you to let it go. The relationship strain is real and documented. This crossing typically coincides with peak founder stress. Longer hours, higher stakes, more complexity. Marriages feel it. Partnerships feel it. Your kids feel it. The people who supported you when this was a dream start wondering when the dream stops taking you away from them. And here's the cruel irony. Just when the outside world says you've made it, just when the revenue number says you should feel proud, many founders experience intensified imposter syndrome. Because management and delegation feel less real than the actual work. You feel like a fraud sitting in meetings when you used to be the one building things. the isolation hits different too. Moving from doer to manager means you can't commiserate with your team anymore. You're responsible for them now. Their problems are your problems, but your problems are yours alone. Research on small business owners shows this revenue transition period correlates with deteriorating health, sleep deprivation, poor nutrition. Skip doctor visits. You're pushing through operational chaos, and your body pays the price. Making more money often creates more financial stress at this stage, because expenses, payroll, software, inventory scale with revenue before profitability stabilizes. Many founders report that hitting $100,000 feels less like celebration and more like terror, because it reveals how far you still need to go and how inadequate your current setup actually is. This is the moment when many founders finally acknowledge they need support, therapy, coaching, a peer group of people who actually understand, because the psychological weight becomes undeniable, and pretending you're fine stops working. But here's what matters most: what you do next. Because you're standing at a fork in the road, and the path you choose determines everything. You've hit $100,000. You've survived the bottleneck, the tax wake-up call, the systematization crisis, and the emotional toll. Now you face the most important decisions of your business life. Path 1. The deliberate lifestyle business. Some founders consciously choose to optimize around $100,000 to $250,000. Lean operations, minimal staff, high personal income, maximum flexibility. This is a legitimate strategy. This is not failure. This is an intentional choice made by someone who knows exactly what they want from their business and their life. Path 2. The scale path. This means embracing the full transition, hiring, systematizing, accepting lower short-term personal income for potential long-term wealth creation through building real business value. This means reinvesting 40 to 60% of revenue back into people, systems, and marketing. That's not a suggestion. That's the math of scaling. Here's where most people get destroyed. They try to have it both ways. They want growth revenue without growth infrastructure. They want lifestyle flexibility without accepting a revenue ceiling. And that in-between space, that's where chronic stress lives. That's where burnout lives. That's where businesses go to slowly, painfully die. Neither path is wrong, but the absence of a deliberate choice is always wrong. You have to honestly ask yourself, do I want to build a sellable asset that runs without me? Or do I want to maximize a personal income and freedom right now? Both are valid, both are respectable, but they require completely different decisions starting today at the $100,000 moment. If you choose the scaling path, you're committing to becoming genuinely good at hiring, managing, and developing people. Skills you probably don't have yet. Skills you'll need to learn on purpose. If you choose the lifestyle path, you're committing to intentional constraints, saying no to growth opportunities that would require infrastructure you don't want to build. The question is, where do you want to be in 10 years? A highly profitable operation that gives you freedom, or an entity worth millions that runs without you? Both paths start right here, right now, at $100,000, because the business that got you here cannot be the business that takes you there. Something fundamental must change, and that change doesn't start with your systems, your team, or your tax strategy. It starts with you, the type of person you decide to become next. That's what changes after $100,000. Everything.